Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, tax loss harvesting. Turn losers into tax savings.
Glad to be here.
So, imagine logging into your brokerage account and seeing a massive drop in one of your core holdings.
Yeah, nobody likes seeing that.
Right. The natural reaction is just this, wave of panic or frustration. You see the red numbers and feel like you're moving backward.
Totally.
But our mission for today's deep dive is to completely rewire how you view those inevitable market dips. Because instead of seeing a failure, you should see a voucher.
I like that word, voucher.
Yeah, a hidden, entirely legal mechanism capable of erasing thousands of dollars off your tax bill. And today we're pulling insights from the Daily Market Briefing, featuring expertise from Investopedia, the CFA Institute, Forbes, and of course the IRS.
The ultimate rule book.
Exactly. Okay, let's unpack this.
Yeah.
Because logically, if the IRS taxes our investment gains, they sort of have to account for our investment losses, right?
Right, they do. But we aren't just talking about taking a hit on paper here. We are talking about, well, weaponizing those losses.
Weaponizing them. I love that.
What's fascinating here is that we are essentially talking about generating what the CFA Institute calls tax alpha.
Tax alpha. Okay, break that down for me.
Sure. So the financial industry spends billions of dollars chasing regular alpha, right? Like trying to get the market by picking the perfect stock or timing a trade.
Which is incredibly hard to do consistently.
Exactly. But tax alpha is entirely within your control. It's the additional performance you squeeze out of your portfolio strictly through tax efficiency.
Oh, wow. So it's about what you keep, not just what you earn.
Yes. It is about recognizing that your true return isn't what your investments earn. It's what you actually get to keep after the government takes its cut.
So if I'm understanding the underlying mechanics, deferring a tax bill isn't just about delaying an inevitable payment. It's about keeping that capital invested. Like if I legally avoid paying $2,000 in capital gains taxes today and I leave that money in the market to compound for 20 years.
That growth becomes huge.
Right. The growth on that deferred tax money becomes a massive driver of my overall wealth.
And that is the core mathematical engine of tax loss harvesting. You deliberately sell an asset that has declined in value to lock in or, realize a loss.
Okay.
You then use that documented loss to neutralize the capital gains you've made on your winning investments.
And the IRS just allows this.
The IRS explicitly permits this offsetting process, yeah. By shielding your gains, you reduce your taxable income for the year, leaving more capital in your portfolio to compound over time.
Okay, so what does this all mean for the everyday investor trying to execute this? Like, what are the actual steps?
So there's a specific playbook, 5 steps. Step 1, you identify eligible securities that have declined in value.
Find the losers. Got it.
Right. Step 2, determine the exact loss amount. Step 3, you actually sell to realize that loss.
You have to actually hit the sell button. You can't just point to the screen and say, look, I'm down.
Exactly. No honor system here. Then step 4, you offset your gains from other investments. And finally, step 5, you reinvest the proceeds into a new security.
Okay, let's run a real-world scenario to see how this offset plays out. Let's say earlier this year, I sold a block of shares in a healthcare company for a $5,000 profit.
Nice trade.
Thanks. But under normal circumstances, that $5,000 is a taxable capital gain. The IRS is expecting a check.
They certainly are. And depending on your income bracket, that tax bill could take a significant bite out of your profit.
But looking at the rest of my portfolio,
Yeah.
I have a position in a technology company that took a severe beating.
Happens to the best of us.
Yeah, unfortunately. So the shares I hold are currently worth $5,000 less than what I originally paid for them. If I initiate a trade today and sell those shares, I transform that abstract paper loss into a realized, documented $5,000 capital loss.
Which leads directly to the offset. You take that $5,000 realized loss from the tech company and apply it against the $5,000 realized gain from the healthcare company.
And they cancel out.
Completely. The two numbers cancel each other out. Your net capital gain for the year drops to 0. You owe no taxes on that successful healthcare trade.
Which means the money I would have wired to the Treasury stays in my account.
Yeah.
But here's the friction point for me. Let's say I still deeply believe in that tech company.
Oh, I see where you're going.
Right. Like, I think the market overreacted to a bad earnings call, and I am confident the stock is going to rebound aggressively.
You want to hold on to it.
I want that tax voucher, but I don't want to lose my position in the company. Wait, what if I still believe in that company? Can I just sell the stock for the tax break today and then buy the exact same stock back tomorrow?
No, you definitely cannot.
Because it feels like returning a sweater you don't like to get store credit, but then immediately trying to buy the exact same sweater again.
That's a great analogy. This raises an important question, and it's the exact scenario the IRS anticipated. They built a regulatory wall to prevent that specific maneuver. It's known as the wash sale rule.
The wash sale rule. Okay.
Yeah. If you sell a security at a loss, but you purchase a substantially identical security within a very specific time frame, the IRS classifies it as a wash sale.
And the penalty.
The penalty is that the loss is completely disallowed. You can't use it to offset your gains.
Wow. Okay, so I imagine the time frame is the crucial variable here. How long do I have to wait before I can buy my tech stock back?
The standard window most investors memorize is 30 days, but the regulation is actually a 61-day window in practice.
Wait, 61 days?
Yeah. It covers the day of your sale, the 30 days after the sale, and this is the trap that catches many professionals the 30 days before the sale.
Wait, how does a purchase before the sale trigger a trap?
It's tricky.
Let's say I own 100 shares of that tech stock and I see it dipping. I think it's at a discount, so I buy another 100 shares on a Tuesday. Then, by Friday, it drops even further, and I decide to sell my original 100 shares to harvest the tax loss.
In that scenario, you violated the rule.
Really? Just from buying days prior?
Because you bought substantially identical shares within the 30 days prior to claiming the loss on Friday, the IRS flags it as a wash sale. You stepped on a temporal landmine.
I see. So the 30-day window is clearly the biggest hurdle here. The IRS is basically looking at a 2-month protective bubble around the date you claim the loss.
Exactly, a bubble.
If you touch the asset anywhere inside that bubble, you trigger the penalty. And the common misconception I hear is that if you trigger a wash sale, the loss is just confiscated forever. Poof, gone.
Right, that's what everyone thinks.
But digging into the Investopedia brief, that isn't mechanically true, is it?
If we connect this to the bigger picture, inadvertently violating the wash sale rule is the most common pitfall because investors simply aren't paying attention to that window. But the IRS doesn't permanently destroy your loss. They defer it by adjusting your math. Let's say you bought a stock for $100 and it drops to $80. You sell it, realizing a $20 loss. 2 weeks later, inside that 30-day window, you buy the stock back for $85.
So I triggered the wash sale. I cannot use that $20 loss to offset my gains this year.
Correct. But here's the mechanism. The IRS forces you to take that disallowed $20 loss and add it to the cost basis of your new shares.
Oh, all right.
You bought the new shares for $85, but for tax purposes, your official cost basis is now $105.
Oh, I see the logic. By artificially raising my purchase price on paper, they are baking the loss into the future.
Precisely.
When I eventually sell those new shares, say, a year from now, when the price hits 120, I'm only paying taxes on the difference between 120 and my adjusted $105 basis. My taxable gain is only $15.
You've got the exact mechanism. The loss wasn't confiscated. It was attached to the new shares and deferred until you finally exit the position completely without violating the window. It is a delay, not a dilution.
That makes so much more sense than the idea of a vanished tax break. But it brings up a practical issue, like how does the IRS actually enforce this? If I'm executing trades rapidly on an app, it feels easy to slip through the cracks.
You cannot slip past the reporting infrastructure. Your brokerage firm tracks the 61-day window algorithmically.
They just do it automatically.
Yeah, at the end of the year, they generate a Form 1099-B, which details all your proceeds. If a wash sale occurred, the brokerage automatically flags it on that form, disallows the loss for the current year, and reports the adjusted cost basis directly to the IRS.
The math is done before you even file. So what does this mean for the automated features we all use? What happens if I have automatic dividend reinvestment turned on? Let's say I harvest a loss on a stock, but a week later the company issues a tiny dividend. My account automatically uses that $3 to buy a fractional share of the company.
That fractional share purchase, no matter how small, falls within the 30-day window. It triggers a wash sale on a proportional amount of your harvested loss.
Just for $3.
Just for $3. It is a highly common pitfall.
No.
Active tax loss harvesting requires turning off automated reinvestments for any security you are managing for tax purposes.
Okay, building on the idea of unexpected traps, let's explore the boundaries of the IRS's reach. What if I try to be clever?
People always try.
Right, I sell the losing tech stock in my standard brokerage account. But to maintain my exposure to the company, I immediately have my spouse log into their separate brokerage account and buy the same stock.
The IRS anticipates that. For tax purposes, spouses filing jointly are considered a single economic unit. A transaction across spousal accounts is treated as if one person executed both trades.
The wash sale is triggered.
Yes, the wash sale is triggered.
Okay, let me try one more loophole. I sell the tech stock at a loss in my taxable brokerage account. Then I log into my Roth IRA, my tax-advantaged retirement account, and buy the stock back there.
That is arguably the most dangerous trap in this entire landscape.
Wait, really, why?
We discussed how a standard wash sale defers the loss by adding it to the cost basis of your new shares. But inside an IRA, capital gains and losses aren't recognized the same way. The money grows tax-deferred or tax-free.
Which means if the IRS forces me to add my disallowed loss to the cost basis of a stock sitting inside my IRA,
It becomes completely useless. You cannot claim a capital loss on an IRA withdrawal. In this specific scenario, your attempt to defer the loss actually destroys it permanently.
oh wow,
Yeah, the tax benefit is entirely neutralized.
that is a brutal reality check. It proves you have to view your entire financial life, spousal accounts, taxable accounts, retirement accounts, as one single chessboard. Now, up until now, all my scenarios have revolved around individual company stocks. So is this purely a strategy for stock pickers? If someone listening primarily invests in index funds or mutual funds, is this irrelevant?
Not at all. The CFA Institute emphasizes that the wash sale rule and the overarching strategy of tax loss harvesting applies to virtually all securities. Bonds, mutual funds, ETFs, capital losses there are just as valuable for offsetting gains.
But how do we navigate the substantially identical rule with mutual funds? Like, if my S&P 500 index fund drops and I sell it to harvest the loss, I can't just keep the cash sitting idle for 30 days. I need that money working in the market.
Right.
Can I just buy a different S&P 500 fund from a competing financial institution?
No, even if the management company is different, if both funds passively track the exact same S&P 500 index, the IRS considers them substantially identical.
So I'm stuck.
Not exactly. To maintain market exposure without triggering the wash sale, you have to find a substitute that is highly correlated but tracks a different underlying index.
Oh, I see. So instead of swapping an S&P 500 fund for another S&P 500 fund, I might sell my S&P 500 fund, harvest the loss, and immediately buy a Russell 1000 index fund.
Exactly. The performance profiles are incredibly similar, keeping your money exposed to the broad U.S. market. But the underlying construction of the indices is different enough to satisfy the IRS.
That is a textbook ETF substitution strategy.
Yeah.
You secure the tax voucher, avoid the wash sale penalty, and maintain your intended asset allocation. And then after 31 days, you can sell the Russell 1000 fund and move back into your preferred S&P 500 fund if you choose.
You've got it perfectly.
Here's where it gets really interesting, because everything we are discussing implies active, ongoing management. Yet, if you read mainstream financial media, tax loss harvesting is almost exclusively framed as a December chore.
Oh, the end-of-year scramble.
Right. It's treated like this frantic holiday checklist item to clean up the portfolio before New Year's Eve.
And that is a massive strategic error. The Forbes insight in our briefing highlights that the market does not limit its volatility to December. Equities and bonds fluctuate continuously.
So it's a year-round habit.
Exactly. A major market correction might occur in March, bottom out in July, and fully recover by November.
Meaning, if I wait until December to look for tax opportunities, my portfolio might be back in the green. I completely missed the chance to harvest the volatility of the summer.
Precisely the issue. If you harvest a deep loss in July, you lonk that tax voucher into your ledger. Even if you reinvest in a substitute asset and the entire market rallies through the end of the year, you still have that July loss banked to offset your December gains. You captured the value of the dip.
And what happens if I do this so effectively that I harvest more losses than I have gains?
That's a good problem to have.
Right. Let's say it's a terrible year for the market. I harvest $20,000 in capital losses, but I only had $5,000 in capital gains to offset. Does the remaining $15,000 of my tax voucher just expire at midnight on New Year's Eve?
No, the IRS provides a highly favorable mechanism for that exact situation. First, they allow you to take up to $3,000 of that excess capital loss and apply it directly against your ordinary income.
Wait, my regular income?
Yes. You can literally use portfolio losses to reduce the taxes you owe on your day job salary.
That is a phenomenal benefit. So I offset my $5,000 in capital gains, and I shield $3,000 of my salary. That still leaves me with $12,000 of unused losses.
And that remaining $12,000 carries forward into the next tax year. You bank it indefinitely.
Wow.
You can use those carryover losses to offset capital gains next year, the year after, or a decade from now. Savvy investors use severe market crashes to stockpile massive tax loss carryovers, effectively shielding their portfolio gains from taxes for years into the future.
It fundamentally changes the emotional experience of a market downturn. You stop being a victim of the red numbers and start acting like a harvester, stockpiling resources for the upcoming bull market.
That's exactly the mindset shift.
This has been an incredibly dense, highly tactical exploration. Let's do a quick, energetic recap for you to take back to your own portfolio management. We've established that tax loss harvesting is the deliberate realization of capital losses to neutralize the tax burden of your capital gains, the pursuit of tax alpha.
We also mapped the parameters of the wash sale trap. The IRS enforces a strict 61-day window around your sale via Form 1099-BB. Violating that window by purchasing a substantially identical asset, even accidentally through fractional dividend reinvestments or across spousal accounts, forces an adjustment to your cost basis, deferring the tax benefit.
Right, we identify that this applies to all securities, not just stocks, and requires a holistic view, utilizing ETF substitutions to maintain market exposure without crossing that identical threshold. And most importantly, we dispelled the December myth. Volatility happens year-round, which means opportunities to bank indefinite tax vouchers happen year-round.
I will leave you with a final thought to mull over. The financial industry conditions us to view a falling stock price as a failure, a mistake to be hidden or ignored until it recovers. But what if we stopped viewing portfolio losses purely as financial failures? What if we completely abandoned that emotional framing and instead started looking at them as strategic, year-round tools for building a highly tax-efficient wealth machine?
Incredible perspective. When you master the mechanics of tax alpha, a portfolio loss is no longer a setback. It is the first step in compounding your future growth. That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.